Hey guys, welcome to my YouTube channel. Today we will do chapter 1 of financial accounting for NCERT class 11 accounts. We will start with introduction to accounting. As you know, accounting we have studied from when we were small. We use it when you're paying money for buying a chocolate or an ice cream. Well, once we reach in 11th, it will be a bit more complex, but then what is with accounting is you need to know some of the golden rules of accounting and then you're set. You can do any kind of formulas, any kind of transactions which they give, you would know how to use it. Well, the first chapter, introduction to accounting. The first page is not that important, so we will directly skip to the second page. Now, what is accounting? In accounting, it's basically the process of identifying. You need to identify, measure, communicate economic information to permit informed judgments and decisions by users of information. What they mean is that you have to prepare accounts in such a way that it will help the third person to find any kind of information which is required. How would you find any information? With proper systematic recording of the data. It should be done in a proper way. You cannot have upside down manners. It should be done in proper order. You cannot take 31st December accounts and put it on 1st January. No, it cannot be done. What the transactions which have been taken place on 1st or 3rd or 4th of January should be done in the same consecutive orders. It should be a sequence. In the diagram, as you can see, it's a continuous process. The accounting process will be used where you're going to start with the formulation of your accounting, where you're going to create different kinds of ledger accounts, trial balances, balance sheet, cash flow, which we'll be learning it in the further stages. That information will be given to use for what? For communicating the data about the company, how the company is, whether it is a going concern company. Now, what do you mean by going concern? Going concern means that the company will carry on in the future. It means that the company will make profits. It won't stop. It won't bankrupt. What is bankruptcy? Bankruptcy is that the company does not have money to pay your suppliers, your creditors, your employees. So the company will shut. That's called bankruptcy. So the main goal for any company is what? To continue in the near future, to make profits, to make money, to keep growing. Now, after you communicate the accounting information, it will be given to your internal and external users, the decision makers of the companies. Now, internal users are who? Your board of directors, your GMs, your CFOs. They will make the decision about the company, whether they have to grow further, they have to expand, or to the external users like the banks. Okay, with these banks, why do you give your information to the banks? So that you can get a kind of loan or some other kinds of benefits from the bank. Then what are the other events, like what are the economic events that have touched the company's decision making processes, which we would go into detail further down. Now, as here you can see, accounting can therefore be defined as a process of identifying, measuring, recording, communicating the required information relating to the economic events of an organization to the interested users. The interested users are who? Your internal and the external users. Next. In order to appreciate the exact nature of accounting, we must identify the economic events. You need to identify, measure, record and communicate, organize the data, and as I told you, the interested users of the information. Well, let's come to the economic events. What is an economic event? An economic event is the one in which it will affect the business's decision-making ability. What are the consequences? What are the internal and external factors that will affect your business? In terms of what? In terms of your monetary. What is a monetary term? It basically means your cash. For example, they mention here purchase of machinery, installations. Now, if you have a factory setup, when you have a factory, you need to take into consideration the location, the transportation. How much will it cost? In case by default there's some other things which have come up. How would those expenses be used? Next is your identification process. Under the identification, you need to identify what is the monetary recording in terms of the transactions. Now, for example, I want to buy from a supplier, so I will pay cash. Now, if you're a car manufacturer, okay, you're going to buy from one place and combine them together as a whole and sell it in another place, correct? So what you will have to consider is what is the cash in and cash out. What are the salaries which have been paid? You need to maintain each and every books of accounts. That's your identification process. You need to identify the things, observing the activities and selecting those events. Next is your measurement. Under measurement is what? It's based on again your monetary units. Guys, remember it's accounts. Everything will be based on your cash in, cash out. It can be either your hard cash or it could be what? It could be credit terms, because you know what is credit. You will tell the supplier, I will pay in a later stage at some point of time. Okay, next. So look, have you see here? It's usually the monetary units. That is why it is important items like the appointment of new managing director, signing of contracts or changes in personnel are not shown in the book of accounts, because those are not required. It's basically what your monetary units. Next, recording. What do you mean by recording? As I told earlier, it should be done in a chronological order in terms of your monetary terms. How? You have to do it in a proper way. You need to identify what has been done first. Now, for example, you're going to purchase a machinery. You cannot say that if you purchased a machinery, say for example on 1st January, okay, whereas the machinery was delivered to you on say 5th of January. You cannot mention in your books that 5th January I got my machinery, so I paid that time. No, you must have paid on 1st January your cash. So your cash was already out on 1st January. That transaction has to be recorded on the day you have given your cash out, not when you have received your machinery. Your next entry would be that you have received the machinery. The recording is in a manner that is necessary for the financial information to be summarized, and is made available as and when required. And lastly, and the most important, is what? Your communication. You need to communicate. Okay? The communication is what? Whatever you have identified, measured and recorded should be communicated to the people. Who are your people? Your internal and your external users. Guys, these are just normal basic definitions which have been given in the book, because it's just the first chapter. So it's very simple to understand. More complex details will be given in the later stages. But this is very simple. It's just normal layman language which has been given in the definition of your books. Okay, before I forget, I've got this online, the book. It's by the NCERT, which has had issued it. It's online. It's free. You can type over there class 11 accountancy books. You will get a full PDF file and you can use it and read it. I would suggest that what you would do is that when I'm explaining this, you have your books open, so you can communicate. You can have a match of the book, like you can see what am I telling and what the book has. So you will be in a proper flow and you will have a better understanding of the concept. So it's by the NCERT again. I will put a description link below. You can have a look on that. Okay. Now next, let's go to organization. Now what is an organization? It's basically your business, the company. What is a company? It can be both. It can be a profit motivated company or a not for profit. Profit companies are who wants to make money. Not for profits are just helping. They do not have any kind of profit motives. So it can be, you have different types of organizations, which can be limited liability, sole, joint companies, municipal, local authorities, and different. Very simple again. It's just what is an organization means what? It's just a company. Next, the interested users of information. As I informed earlier, we have two interested users, which is your internal user and your external users. Well, for the internal users, who are those? Your CEOs, your CFO, business unit managers, your store managers. Why is it important for them? For expanding any business, you will have to take a kind of decision whether my company is really making profits that I can expand the business or not. So it is very, very important for the internal users. Next are our external users. As I told you, the creditors. Now, what are creditors? They are the suppliers of the company who provides companies with certain kind of items, and then the company tells them, okay, I will pay you later. So for the creditors to give you a kind of a credit facility, they have to know that the company is making money. They have to know the company has profits. They will get their amount back, because they should also have a kind of satisfaction with them that whatever supplies they are giving, they will receive the money. It won't be like they will lose it. Then you have the taxing authorities, the trade associations, stock exchanges. There are many kinds of external auditors, external users, who plays a very important role. They want to know the information, especially when you go in the public, when the company is a public market. What is the public market? They are into stocks. That time it plays more important role because there are other people who are going to put money into that company. So they should have a kind of satisfaction that yes, the company is a profit making company. Okay. There are other types of accounting informations which will be used in the later, which we'll be studying later. Now here, why do the users want accounting information? So what is the benefit for the users? Why do they want it? Well, the owners and the shareholders, they would require it because of what? The financial health of the company, to see that whether the company is growing. Guys, if you see, I'm again repeating and repeating the same things because chapter 1 is just the basic, it's just the introduction for you guys to understand what are different definitions which is being used in the accounting terms. Okay. Next one, the directors, the managers. Like, now why would the managers of the company? You will work in that company only if you get a pay, you get a good salary, correct? So in that case, the managers will only work to evaluate the performance because they know that if the company grows, their salaries would increase. Next is the creditors. As I told you, to get their money back, you will get paid back. The prospective investors use them to assess whether or not to invest their money in the company. Now in case, what does this mean? The prospective investors. As I told you, if you want to develop a project, the company doesn't have the necessary funds. And say for example, you're looking for a kind of an investor, so that means a third party who has to invest in the company. That is the time when the investors will ask for your books, especially the balance sheet. We will come to the balance sheet in the next part, but then in a brief, balance sheets are what? It includes your assets, liabilities and your equity. I will explain each and everything later, but for now, in the layman terms, an investor is the one who will invest money in the organization. For example, you will not invest in any company if you do not get any kind of profits. The same thing with the investors. They won't invest in any kind of companies if they don't expect to get a better returns or say a higher returns in the future. Next, accounting has a source of information. Now, as I told you before, each and every step in accounting plays a very important role because each and every step generates information. It is not an end because it keeps continuing. It's a continuous process. There is a flow. Those flows will help for the interested parties to take appropriate decisions. It's a continuous process. You have to make sure that that information helps in making economic decisions. It helps to know whether the company has potential cash flows or not, whether the resources which the company has, is it good enough to meet the company's goals in the future and current. Okay, to provide factual information by disclosing underlying assumptions on matters subject to interpretations, and also provides information on activities affecting the society. So the role, what is the role now? The role of an accountant. Now, as you know, this is a general, what I explained was about accounting. Now we know there are different kinds of roles in accounting. You have accountants, you have financial accountants, you have CFOs, you have finance managers. There are different kind of roles. The main role of an accountant is what? To observe and screen, recognize the events and transactions. That's a very important thing which you guys should remember, that the role of the main accountant, they are the ones who start, they are the basic main people who passes the transactions, who records the transactions, who compiles all the reports together, and okay, and then they give it to the later people, means the higher managers. They are interpreted, decoded and used by managements and then other user groups. As I told you, there are different disciplines: financial accounting, cost accounting and management accounting. Now we'll do it one by one. Now what is first one is your financial accounting. So what is the financial accounting? It means what? A systematic record of financial transactions. Means a chronological order in which the accounting must be maintained. It is a way of preparing your financial reports to arrive at a success of the financial soundness of the company. It's very simple. That's normal financial accounting. Next is cost accounting. Now this usually comes into picture when you are into manufacturing services, because when you're manufacturing, you're buying some raw materials from one, you're going to make the end product and sell it at a higher price or at a lower price depending on how your calculations are to the end product, which is the customers. So under the cost accounting, you have to make sure that whatever your supplies you're buying, what you're adding into it and what you are selling it to the customers, it makes company profits or it makes a company a break even. That's your cost accounting. Okay, whereby ascertaining the cost of various products manufactured or services rendered by the firm and fixation of prices thereof. As I mentioned, when you're going to pay a supplier, because you're going to sell the raw materials. You're going to sell the end product. After you're going to get the raw material, sell the end product to the customers. So that is your cost accounting, where you need to know what is the costing of each and every item, which is before selling it to the customers, how you're going to make profits out of it. And the last is your management accounting. What is management accounting? It is necessary of accounting information to people within the organizations to help them in decision making, planning and controlling your business operations. So it's simple, right? What is the management? It helps in what? To take decisions about your budgeting, profitabilities, pricing decisions. What are the other kinds of decisions available in the company, where it can be quantitative or qualitative terms, where how can you forecast your sales, your cash flows, all those kind of things come under your management accounting. So what were the three things which I explained? Financial accounting, cost accounting, and you have is what? The management accounting. What is financial accounting? The preparation and the presentation of your financial reports. Cost accounting, the costs of the manufactured goods, which is basically how is the fixation of the price, what are the services rendered by the firm. And last is your management accounting, which will help in any kind of decision making, planning and controlling the business operations. So we finished those three. Now let's come to and see what are the qualitative characteristics of accounting information. Guys, please remember this. It can come in the exam. Okay. What are the qualitative characteristics? It's basically what? Your reliability, relevance, understandability and comparability. It's called R square UC if it's easy for you to remember in short forms. Okay. R square UC is what? Reliability, relevance, understandability and comparability. Now, what do you mean by reliability? Let's break it down. What do you mean by reliable? Reliable means what? That the information you can rely on it, right? You're dependent on that information. You are sure that the information is right. You're reliable, you can rely on it, correct? That's what reliability means. It's what the accounting information what we have received, it's what has been displayed. It should be what free from any kind of errors and bias, and faithfully represent what it is meant to represent. You should not bias means what, not should not create any kind of fraud or any kind of something irregular things which will distort how the financial statements are disclosed. So it should be reliable. It should be so much in that it should be so accurate. It cannot be, sometimes there are mistakes available, but then it should be free from any kind of errors. That's your reliability. What is my second R? My second R is relevance. What do you mean by relevance? It means that relevant, the information should be available in time. You need to not, like in case if the transactions happened in January, you cannot pass those transactions of January in the month of March. There's no kind, so in case anybody, if the management asks you in the month of January to give you some kind of information, you will not be able to give at that period of time. That means it is wrong. The information must be available in time. It must help in the prediction and feedback to influence who? Again, the useful decision makers. Then is understandability. Now, as you know, accounts is like a vast subject. We are still in the starting. But then for understanding, so that the managers to understand the information, it should be interpreted in a more easier way so that it makes sense what the information is being prepared, what has been informed to them. If you give them in a messed way, they won't understand. And if you don't understand, they won't be able to give you the right picture, correct? They won't be able to take any kind of decisions in the company. So they won't know whether the information is good or bad. So that is what it means by understandability. When you're preparing any kind of statements, especially in accounts or any kind, even when you're preparing presentations in schools, the information should be prepared in such a way that it's easily understood by the third party. Maybe you would understand what you're preparing, but always keep in mind that when you're preparing such kind of information, it should be understandable by the third party, that okay, I understood what I have to convey, so that he can take a proper decisions. And then we have last, which is your comparability. Now, under comparability is what? You have to compare the statements, correct? Now say for example, you have past data. So you can compare with your past data and your present data in a quarterly way, annually way, semi-annually. It depends how the company prepares it. So for financial reports, what are they saying is that the use of the general purpose financial reports are able to compare various aspects of an entity over different time period and with other entities. Other entities are like what? You have a competitor, correct? You and your competitors are same. So you can get the information online of the balance sheets and all, because now everything is available online. So you can compare, okay, that how much did I perform in this particular period and how much did my competitor perform in that particular period. When you compare, you get to know how you are performing. So you understood that is your qualitative characteristics. So what are the qualitative characteristics? R square UC, which is reliability, relevance, understandability, and comparability. Now next, objectives of accounting. What is your main objective? Why are you preparing accounting? What is the reason behind it? We know that we have to give the information to the internal and external users so that they can help in growing, expanding the business or growing. But then what else? Also to know our profit and loss accounts and balance sheets. Correct? It is additional information. That's the reason we have to prepare our accounts timely manner so that it will give us a proper details of it. Next, maintenance of records. What do you mean by maintenance? Now, in maintenance, it basically means that whatever information you have to properly file it out. You cannot keep anywhere. You cannot keep your expenses in your sales file, sales in your payments file. No, there should be no. The filing should be done properly, that each and every file should be kept separately. And then there are different transactions, purchases, sales, receipts. So you should record all your financial transactions in the books of accounts in a systematic manner. It will help in what? Verifiability, and acts as an evidence. Because as you know, there will be tax authorities, correct? You have to do your audit reports at the end of the year. When you do audit reports at the end of the year, the auditors will come and ask you for proof. On what basis did you book an expense? On what basis did you book a sale? So those all information should be kept in a timely manner. Well, as you know, once you enter any company, they have different kinds of accounting softwares. Tally, ERP, you have a SAP, you have different accounting softwares. So when you pass any entries in those softwares, you will have the numbers which are being generated in that. Based on those numbers, your filing will be according to that. And it will be detailed, supporting documents. You cannot simply pass an entry and just put that paper. No. There should be supporting documents for each and every transaction. On what basis did you calculate things? Because if that you do not have a proof, the auditors will question about what kind of accounting has been recorded in those, and it will be a negative point for the company. Next, let's move to profit and loss. Now, what is profit and loss in very simple terms? What is profit? I made money. Loss? I lost. I do not have, like, I'm bankrupt. I don't have anything. I do not know what to do. I'm putting money out of my pockets. Correct? That is what. So for profit and loss accounts, it's whether the business has earned profits or not. Now this is a diagram which has been showed here, where you can see there are qualitative characteristics of accounting information. Okay, then there are the decision makers who needs to understand that. And then whether it's relevant and reliable. Under relevance, you have what? Dedicative value, feedback, timelines. Reliability is your verifiability, faithfulness, and neutrality. So this is what the qualitative characteristic of accounting information looks like. Okay guys? Now, another objective of accounting is what? The profit earned or loss sustained by a business during an accounting period, which can be easily worked out with the help of income and expenses. Now, when I see my profit and loss account, I will get to know how much is my income over my expenses. Correct? So based on that, you will know what are the areas where I will have to reduce my expenses. How can I make more profits? What are the areas I can make profits? You know, you have to check your business. You have to read the details of the data available. Now here, they have given an example. If the total revenue is rupees 6 and total expenses are 5.4, then the profit will be what? You have to subtract. You made how much? 60,000 rupees. Because you still made a profit out of it. It's basically what? Your expenses minus your revenue, which will give you your profit or your loss. Next is the financial positions. What is a financial position? It's basically what? A financial position of the business is for your assets and liabilities, which is your balance sheet. The company's financial position, guys, remember, it is your balance sheet. That is the one which will depict what is your assets and the liabilities. A proper record of resources owned by the organization, which is your assets, and claims which has to be given is called the liabilities. Claims are what? What you have to pay. For example, if you have taken a loan from the bank, correct? You have to pay. Then if you have taken any kind, if suppliers have given you credit, you have to pay the suppliers back. Those are your liabilities. So that is the financial positions are what? It's your balance sheet. That is called as what? As I have mentioned here, it is known as your balance sheet position statement. They might just ask you in the exam, what is the company's financial position, or calculate the financial position of the company. What is the financial position? It basically means your balance sheet. In the later stage, we will see that the balance sheet has what? There's a formula for it which will be given in the later stages. Let me see if it's here. 1 minute, guys. Okay. So the balance sheet is equal to what will be mentioned will be like basically it's in the later stages, but then yeah, it is just for your knowledge.